All right, here's what we've got. Welcome to the bigger picture. How should investors invest in chaotic markets? What are some lessons we can take away from some of the roller coaster rides we've been through in the past few weeks? Let's check in now with Ritesh Ganeriwal. He is the Head of Investment and Advisory at Syfe. Good morning, Ritesh. How are you doing today?
Hey, Ryan. I'm doing good. Thanks for having me here.
Great having you on. So we've been going through quite a bit of turbulence in the past few weeks. What have been your major takeaways with how the narrative has changed so much in such a short span of time?
Yeah, absolutely. So I guess, let's take a step back, right? Over the course of the last couple of years, equity markets have continued to rally in spite of, the interest rates going up. And as we move forward, earnings growth was a primary driver for, the equity markets to continue moving up on an annualized basis. The economic growth was looking very, very solid in spite of these high interest rates. Over the course of the last few weeks, however, we saw some news bites, particularly on the, economic front with respect to, say, unemployment data. So this was a big trigger point to the market because the market was almost pricing that there is no recession fears. But the unemployment data ticked up to 4.3%. And that was a big trigger point for the markets to take a step back and get into a little bit of a panic mode. And this was kind of exaggerated because there were overcrowded positions, specifically into the mega cap tech stocks, as well as the unwinding of the JPY carry trade. So all of these kind of compounded the panic in the market, and that led to a sharp sell-off in July. But as you can see, over the course of the last week or so, most of those losses have been pared back, and we are back into the normalized kind of scenario. So yeah, as we move forward, I think the market was a little bit too apprehensive and got a little bit too panicky with respect to potential recessionary fears. But as we look at the economy, we see the markets and the economy more like normalizing than falling off a cliff.
Yeah, so this really brings to question how active an investor should be in monitoring markets, right? You've got a portfolio, typically it's a 60-40 split between equities and bonds. How often or regular should you be repositioning or readjusting your portfolio?
So I think at this juncture, when you're thinking about long-term investing, usually you should not be touching your portfolio due to short-term market movements. And that's, I think, the golden advice that I give to clients, that don't panic during these situations, because market corrections are part and parcel of the game. On an annual basis, there is double-digit correction almost once every 2-3 years in S&P 500. But the reality is the market comes back stronger. And if you miss a few days of the rebounds in the market, then you can miss out a significant portion of your returns. Now, coming to investors, I think these market sell-offs are important checkpoints for them. You should really look into your portfolio and see if you have concentrated positions. If you're really loaded into growth stocks and mega cap tech stocks, these stocks are priced to perfection. So if there is any negative news bite, there can be compounded effect on your portfolio. So it is good to take a look at your portfolio, review concentration risk, see if you are fairly diversified. I think we were back in 2022, the 60-40 portfolio was supposed to be dead. But now this is a revival phase, in my opinion, for the 60-40 portfolio, because as rate cuts gonna happen over the course of the next few months and year, bonds are supposed to benefit much more, and they're gonna outperform stocks from a relative basis. So if you have a 60-40 portfolio, then bonds can give you not just high yields as they stand right now, but also capital appreciation, and which means that your 60-40 portfolio bonds can give you equity-like returns at half the risk that you're taking.
Okay, you mentioned tech has been priced to perfection, so you should be looking perhaps elsewhere for value. You mentioned bonds. What type of bonds are we looking at? And also in the equity space, is there any more value to look at?
So typically bonds outperform equities 3, 6, and 12 months following a rate cut. If you look at bonds prices are inversely correlated with interest rates, and typically rate cuts are associated with also some sort of an economic slowdown, making bonds kind of like safe haven. Also, I think if you look at the amount of money that is sitting in cash right now, there's almost $6 trillion of cash sitting in money market funds, because I think most of the investors over the course of the last year or half, they have remained a little bit less invested into the equity side, and they have loaded up on, money market and cash, because rates on the safe haven instruments have picked up quite meaningfully. So people want to not take that extra risk and, kind of have that certainty in returns. But Now, if rate cuts are going to happen, all of these instruments will be subject to reinvestment risks. And that's why bonds, particularly are well suited to capture a lion's share of this $6 trillion of money market funds that are sitting on the sidelines. On the equity side, similar to how, I talked about bonds, if you look at the stock market from sectoral perspective as well as, value and small cap perspective, value stocks typically outperform growth during the initial, 6 to 12 months after rate cuts. Similarly, small cap stocks also catch up and they also start to outperform 12 months, mainly due to their ability to capitalize on lower interest rates. When it comes to mega cap tech stocks, they are at already a very high bar. They're trading at rich valuations, which can be impacted by any kind of small negative news, right? We have seen through the earnings cycle that the earnings have been a mixed bag. And even though the earnings growth remain high, it's definitely slowing down for the mega caps versus it is starting to actually pick up for the small caps, etc. as well. So when it comes to, looking at things going forward as interest rates come down, these sectors stand to benefit. Plus the earnings growth for, the stocks beyond the Mag 7 are poised to actually log their first earnings growth since late 2022. This is a strong sign that earnings are actually broadening out. And when you look at overall, say, S&P 500 trading at 21 times forward earnings, the mega cap tech stocks are trading at more than 30 times, forward earnings, while an equal weight S&P 500, which then encompasses some of these value and other sectors, defensive stocks, they are at 16 times earnings. So definitely there is a lot more value that can be captured across the market.
All right. So we've been talking about bonds, equities, and I'm wondering as well, safe haven places for folks to diversify into. Where should we be looking at? I'm wondering if the Japanese yen is becoming a more interesting proposition now as we see the potential for it to strengthen.
If you look at the Japanese yen, particularly over the last few weeks, I think the yen strengthening was kind of driven because of an unprecedented move to increase interest rates in the Japanese market. Since then, however, the forward expectations have been tapered down. And what that means is the carry trade can be back, meaning that the Japanese yen can continue to again start to weaken to a certain extent, maybe not going back to the 160 levels and all. But overall, I think the panic that has set in from the carry trade perspective, it's definitely evening out to a certain extent. Because I think, again, the point is when it comes to the broader economic growth on a global basis, we are seeing more of a normalization story at this juncture versus, pure recession play. So, of course, the probability of recession has slightly increased, but that does not mean that we need to shift all the way to the safe haven side of things yet. There are, risks that you should be careful about as we move forward, whether it is geopolitical risk, whether it is election risk, whether it is, recession risk. But as we stand right now, I think the data is still pretty optimistic in terms of forward growth and forward earnings. And I think from a market perspective, that presents us with a lot of opportunities, particularly in the bond side. I think it's from a safe haven perspective, you could still look at bonds, investment grade corporate bonds, which stand to benefit quite tremendously, in my opinion, as interest rates, come down, the prices will increase and there is less credit risk attached to them.
All right. Bonds looking more attractive in the coming months. We've been in conversation with Ritesh Ganeriwal. He is the head of investment and advisory at Syfe. Ritesh, thank you for the time and insights this morning.
Thank you, Ryan. Pleasure to be here.
Great chatting with you, Ritesh. Stay Money FM 89.3.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance. To listen to more great interviews, download our podcasts at audio.sg or download the audio app. That's AWEDIO, audio at the App Store and Google Play.